Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. Pretty excited for my next guest. His name is Keshav Kolur. Keshav is a full-time real estate investor. He's the founder of Clive Capital. It's a private equity firm based out of New York City. Clive Capital invests primarily in build-to-rent development, multifamily real estate, and explores oil and gas, debt funds, and also small-cap businesses. He's also the host of the Generational Wealth Podcast. Keshav, thank you so much for being with me. I really appreciate it.
Yeah, thanks so much for having me on, Benson. And it's called the Investing for Generational Wealth Podcast.
The Investing for Generational
Yeah.
Wealth Podcast.
Yeah, I apologize. I don't want to be that guy. I was just correcting the host a few minutes
No
in.
problem. It's good to know,
Yeah.
right? Because you probably have a following here, and we want to get into some of the things you talk about on your podcast too, because I think it's so beneficial to your audience, my audience, just people in general out there, that there are other ways to invest our money that maybe are outside the box, and just some of us just don't know about it. So yeah, I know, I appreciate that. So a lot of investors, especially people who start off in this sort of syndication world, come from, finance or business backgrounds, but you were developing adaptive cruise algorithms, actually adaptive cruise control algorithms in Detroit before pivoting into real estate. Tell me about that transition.
Yeah. Did it say that on my speaker sheet? Did you look me up on LinkedIn?
We just do a little bit of research.
Okay, gotcha. Yeah, because
Yeah.
I don't know. I forgot that part of my life existed, honestly. It's 5 years ago at this point. 4 years ago. Still seems like an eternity. But
Yeah.
so graduated college 6 years ago, 2019. Started working in Detroit as a software engineer on adaptive cruise control and other algorithms for autonomous vehicles. And at the same time, coming out of college, I also read Rich Dad Poor Dad, and the purple book that we all know and love. And so that got me thinking about real estate. And previously, all my friends and family had only been in the stock market. So that opened up my eyes that, hey, I should start looking at real estate. And I didn't get syndications from that book. Maybe I should have, but it at least got me thinking that maybe I should go and buy residential properties and rent them out. But at the time, I didn't have, one, the experience in real estate, or two, the capital. So I actually became a realtor, got licensed on leap day of 2020. And so February 29th, 2020, 2 weeks later, COVID happened, as we all remember, markets shut down. And fast forward later that summer, I helped a couple of folks buy and sell homes. Accumulated some capital from that, as well as my day job as a software engineer, and started looking at properties to buy. And luckily, before I went too far down that rabbit hole, one of my good friends from college, he sent me a Reddit post where someone was talking about buying apartment buildings. And this person who had invested into over 40 single family homes was saying buying apartment buildings is easier. You can do it actively or passively. It's more lucrative, and the tax benefits are better. And so to me, this sounded way too good to be true, right? Because if all of these things were the case, why isn't everyone doing it? Why didn't my parents invest? Why aren't my friends investing? So I actually took a year from September 2020, when I first found out about this, to September of 2021, and just did my due diligence, did research, networked with people in the industry, practiced analyzing investments, read books, watched YouTube videos. And once I got comfortable, made my first investment into an apartment building in San Antonio. And at that point, this was in September 2021, started seeing the cash flow coming in. And that was a proof of concept for me that, hey, this works. And if I'm going to do this for myself, then I want to do it for my friends and family and anyone else who's interested too. So formed my company, Clive Capital, in January of 2022. And our goal is to help primarily tech professionals. Folks, a lot of our investors are from Amazon, they're from Meta, that's where my background is, they're from Google, Microsoft, etc. Help these folks invest passively into private equity opportunities to build all the things that we love and we're all after, right? Generational wealth, financial freedom, passive income, all of that stuff. So far we've helped investors, again, from primarily these big tech companies, invest into over 1,000 apartments under renovation, 500 single family rental homes under development, industrial real estate, and private lending opportunities, and oil and gas as well. Not saying we own 100% of all of this, but these are the types of opportunities that I've helped my investors allocate their capital into passively.
Sure. That's pretty diverse, especially for a newer fund, right? Sometimes newer funds are really sort of laser focused on one asset class. What was it that made you decide to go so broad so quickly? And because that investment thesis is important when you're talking to investors, and it might be complicated for them to understand all these different opportunities. Do you just learn what they're interested in first before you present the opportunities so that they can focus on that one thing?
That's a great question. So over the last 3 years, I've had hundreds of investor calls, and then I've been evaluating opportunities myself. So I've come to learn that there are 6 factors that I have found so far, at least, that investors look at when they're making investments. Number one, probably one of the easiest ones, appreciation. How much is the value of this asset going to increase over time? Number 2 is cash flow. How much is this going to pay me on a recurring basis? Number 3 is tax benefits. How can this reduce my tax bill to Uncle Sam? 4 is risk. 5 is liquidity. Is my capital locked up for 90 days or is it locked up for 7 years? And then the last one, the 6th one, is actually impact investing or charitable investing, right?
Mm-hmm.
So I found that obviously everyone has their own blend of what kind of investments they're looking for. And even during the course of your own journey as an investor, your priorities change. Early on, you probably want to focus more on appreciation. And then as you build up a large, nest egg, a large base of investments, you probably want to shift more and more to conservative cash flow. So when I talk to investors, they express their various needs, right? Usually in some level, way or form across these 6 axes, if you want to call it that, 6 characteristics. So I go out and find investments that fall in anywhere along the spectrum for each of these 6 categories we mentioned. So we started out in multifamily because that's the easiest for anyone to understand, right? We all have lived in an apartment or a rental home or even a single family home at some point, or we've seen apartment buildings. It's pretty easy to say, hey, here's how much we collect in rent, here's our expenses that we have to pay, insurance, utilities, admin, payroll, etc. Here's our profit. So we started out with multifamily. We also got into ground up build to rent development because I personally like the space a lot, and obviously for appreciation, development is a pretty good play, right? And I would say multifamily is a good starter across the board. Good appreciation, good cash flow, good tax benefits, pretty low risk, not great on liquidity. And then it depends how you view, investing into apartment buildings from the charitable lens. But that's multifamily and built to rent. Industrial, we expanded into because I would say that's the even safer asset class, in my opinion, than multifamily, and we really like that. We also found an operator who's been around for a decade, and so that just made us feel really comfortable. Where if we have an investor who's really risk averse or really wants to see a longer track record, then that's probably the investment that's best for them. We have private debt opportunities, and that is primarily focused on cash flow and liquidity. So one opportunity we're raising for right now is projecting a 16 to 18% return, and your capital is only locked up for 1 year.
Mm.
And we're looking at another opportunity that's locking up capital for only 90 days. So that's why private debt interests us right now, especially with where rates are and the fact that we don't see them coming down anytime soon, just with the fact that inflation has been a little stickier than we would have all hoped for.
Yeah.
And then lastly, oil and gas, coming from the tech world, real estate's tax benefits are great. Depreciation, we love it. It's better than the stock market, which is sad and tragic when it comes to tax benefits, honestly. But for a lot of people in tech, they're not a real estate professional. Their spouses aren't real estate professionals, but they still make a good income. Their investments do really well in the stock market, and they live in really high tax areas. And, typically the tri-state area, New York, New Jersey, Philly, or they live in the Bay Area in California. They just get taxed to death. So they're always looking for ways to offset their W-2 tax liability or even capital gains tax liability. Now, unfortunately, real estate can't help them do that because they're not a real estate professional, but the tax benefits that we get in oil and gas are amazing. Every 100K invested, we're able to reduce our taxable income, W-2 income or capital gains tax bill by 80K for every 100K invested, on top of getting cash flow. So when I'm looking for investments, it's just a matter of finding one, what are my investors looking for with that 6 criteria that I mentioned, and then going out there, finding an asset class, one, and then two, an operating team that I really trust, that I really like, that's an expert in that area, and partnering with them. And that's how I'm diversifying into multiple asset classes, not only for myself, but also for our investors.
Do you know Sean George from Limitless Capital?
I don't know.
I might have to make an intro. You guys might be able to do some business together. He's doing some ground up construction as well and raising money for that. And he's looking for some partners. So I might have to make that intro for you if you're interested.
Oh, yeah, that sounds good.
Yeah. Can you explain more about the tax benefits of oil and gas and how they're different than if someone just invested into a multifamily syndication?
Yeah. So with multifamily, what we're seeing right now is maybe a 40% depreciation in year one, like that you can see on your K1. So maybe every 100K invested, you will get $40,000 in depreciation. And for those who don't know, depreciation is the government basically saying, hey, we recognize you've bought this asset, whether it's real estate, whether it's equipment, whatever it is. We realize you bought this, it has a useful life, right? Eventually, for example, the doors in your apartment building aren't going to work after 20 years, or they won't work as well. And technically that's an expense. The fact that they're losing their useful, life or their utility over a period of time, and that's an expense we have to incur as business owners. So the government wants to obviously incentivize investments. So they say, hey, business owner, we know you're making this investment. We're going to let you write off X percentage of your investment over this time schedule, right? Maybe it's 40% year one, 10% year two, 5% year three, etc. So what that means is, let's say you bought an apartment building and when you do what's called a cost segregation study, they come back and tell you that you can claim a 40% depreciation, meaning every $100,000 invested, you can show a paper quote unquote loss of $40,000 because your investment is depreciating. It is technically losing value over time unless you do constant upkeep on it. So let's say you invested the 100K, you show a loss of 40K. Let's say every year in cash flow from the tenants paying you rent, you make 8%, $8,000. Year one, you make $8,000, but you're showing a paper loss of 40,000. That means that you're still in the hole, figuratively, $32,000. You don't actually lose those $40,000. You're just showing the government that, because your building's losing value, technically on paper, it's as if you lost $40,000. So that $8,000 you get in year one doesn't go taxed in year one because of depreciation. Same thing in year two. You're in the hole 32, you make another 8K. Now you're still in the hole, but you're only in the hole 24K. Year three, you make another 8K. Now you're only in the hole 16K. Year four, you make another 8K. You're only in the hole 8K. Year 5, you finally break even. Now, in year 5, so let me pause there. That's great, right? Because if you're in the stock market, that would have been taxed, unless it was, qualified dividends or whatever. But even then, I think that gets taxed at capital gains levels. So that's good. You're not paying tax the year that you make the money because of the benefits. But once that benefit runs dry or runs out, you're going to start paying taxes. I should also say that depreciation only applies to passive income, right? That only applies to rental income that you're making through your syndications. It doesn't apply to your W-2 income, which, at least for those who are starting out, that's where you're making most of your money. In oil and gas, what we're doing, the business strategy, is we have what are called landmen in oil and gas who are similar to realtors in real estate. Landmen track the transactions of mineral land. So when they see that a company, for example, Exxon, is buying a bunch of land in an area, they know that Exxon has paid geologists to do studies and find deposits of oil and gas underground. Once they found those deposits, they start going in and buying land to drill. Once the landmen notice that, then they obviously let us know, and we go in and we buy land in that area as well. As long as you own land within the vicinity of where the drill bit goes into the ground, doesn't have to be the exact, square inch that it goes in, but within the general vicinity, you as a landowner are entitled to a portion of the revenue. That comes from drilling, extracting, and selling that oil and gas. That's how we're getting a monthly cash flow from the oil and gas investment. So I invested in November of 2023, and every 100K invested for the first few months, I was paid 4% per month, if I'm doing my math correctly. Yeah, 4% per month for maybe the first 6 months or so. Then it started decreasing. Now I think, 13 months later, we're at 1.5% per month that we're getting paid out in cash flow. That's the returns perspective. For easy numbers, in the first year, I made a 40% return on just monthly payments from being a landowner in mineral land. On top of that, we acquired what's called a working interest in the land. And this is all still new to me. So I'm still ramping up myself, but this is what I understand so far, is we acquired a working interest in the land. And what that means, the risk in acquiring that is if the company needs money, the drilling company, we have to come out of pocket to pay. My partner that I invested with, who's been doing this for decades, she's only had to come out of pocket a few times and for a couple $1,000s. So the risk's pretty minimal. But in exchange for taking that risk and the general risk of investing into oil and gas, you get to write off the depreciation in oil and gas, like in the investment, that comes from us depreciating the equipment. There's not as many buildings, it's the drilling equipment that's being depreciated. We're able to, again, every 100K invested, typically claim a deduction of 80K. And depending on your tax situation, that usually translates to a savings on taxes of 30 to 40K.
This is even if you don't have to come out of pocket. If they do,
Yes,
I don't know what they call it, but like a capital call, like they're not taking the money from you, but just as you've allocated it to them, you still get that 80% deduction.
I believe that we just bought the land. We didn't even give the money to the oil company, like as I understand, we bought the land. But what we're saying is if the oil company needs money, then we will come out of pocket for it. That's my understanding.
So it would come out of a different pot that you use to buy the land with. It'd be a completely different account.
It would be as a capital. It would be like a capital call, basically.
Yeah.
Yeah.
Interesting. So how does that affect the overall ROI? When you look at if someone didn't need those tax benefits, but they had access to them versus somebody who is just investing in a multifamily syndication, is that part of the strategy? Like, well, we need to really look at what you need to offset first before we even look at doing the oil and gas land investment, because it may not make sense otherwise.
I would be hard pressed to find someone who doesn't have a tax problem, especially in this country where we're being taxed to death on like nearly everything. I mean, this is probably one of the better countries out there. But it doesn't only reduce W-2 income. It reduces W-2 income up to $250,000 of
Oh, so
deductions.
that's an important distinction there, right?
There is a limit, yeah.
Because with multifamily, the deduction is only on passive income, not active or W-2
Yes.
income.
Yes, this is on W-2 income, and that's one of the big things that why people love it, right? So that's one big thing. I don't know how it would work for business owners. That's something we're looking into, like
That was going
self-employed
to be my
folk.
next question. What about somebody who's self-employed, who
Yeah,
is doing W9 or 1099, or has, a K1?
yeah, that's something we're looking into. It also reduces an unlimited amount of capital gains, stock market, real estate, whatever it is. So
Hmm.
regardless of what your situation is, you're making money somehow. And I'm guessing, unless you have some sort of, uh, structure in the Cayman Islands where you're not paying tax at all on anything, you have a tax bill from somewhere for something. So
Right.
yeah, I think the tax benefit's a huge part of it, but the returns aren't anything to joke about either. You usually get your capital back, your original principal, within 24 to 30 months. On top, and
That's
then
relatively short compared to a multifamily syndication, which is anywhere from 5 to 7 years on average, right?
yeah, and then but you still cash flow even after that, right? So at that
Hmm.
point, it is what we like to chase in real estate, which is infinite returns, right? We all like to get in that point where we have no capital in the deal, everything's refinanced out, it's cash flowing. We rotate our capital into the next deal. That is what typically happens in oil and gas opportunities after 2 to 3 years.
Mm.
Yeah.
So then I started thinking to myself, well, why would I put any money into a multifamily then instead of just dumping everything into oil and gas?
Well, the risks are, and I mean that's a great transition because you there's no risk-free investment on this earth. And so with oil and gas, before we make it sound like it's too good to be true, one, the risks are one pretty easy risk to spot is the fact that you hit a dry well, or two, your well is underperforming, or
Hmm.
three, that even if the oil and gas is underneath, it's not commercially viable to get to that oil and gas. Like as you drill, you find that you just can't drill past this certain bit, right?
And four would be
How
the government regulations.
four would be government regulations. I think now with drill baby drill, that's maybe not as much of a problem.
Right.
But, like even during, again, I invested in 2023, in November. Still with a full year left in the previous administration. And so at the end of the day, once those wells are online and drilling, like I don't know that there's much you could do to stop that. As long as you obviously buy in the right areas. We buy in the major like mineral formations. There's 6 in the country. We buy in 4 in Texas, New Mexico, Colorado, Wyoming. All of these states, like their economies depend on oil and gas to a certain extent.
Hmm.
So I don't know, I'm not worried as much about regulation. I'm worried about one, like, can we hit the projections that we made, right? Like we project that we're going to be able to get 1 million barrels of oil from this well over the next 30 years. How accurate is that? One thing we do to mitigate that is we buy multiple wells. So if we buy a package, like we did a raise, I helped some investors get into an opportunity in December of last year, like just a few months ago, to reduce their 2024 tax bill. And they invested into 8 different wells. So even if one well is dry or difficult to get to, you still have 7 others that,
Hmm.
you can put your eggs into, proverbially speaking. And that's one way we mitigate risk. Regulation, I think I'm not as worried about that risk, especially here over the next 4 years. Another risk to watch out for is the fact that oil and gas, these are globally traded commodities. It's an international market. Real estate's
Hmm.
local, right? What someone does in Texas isn't going to impact your apartment buildings as much in Denver, right? In oil and gas, your oil and gas investment is impacted by OPEC. and what Saudi Arabia decides to do, what Russia decides to do with the supply of oil. And so it's very volatile, as we've seen. So that's one thing to be concerned with. I mean, and that's why we have various investment types, right? Some are safer, and they might not be crazy cash flow plays or crazy tax benefit plays, but it's your bread and butter multifamily standard 5-year deal. And then maybe depending on your risk appetite, 20% of your portfolio is these oil and gas deals, right? It really depends, but every investment has its risk, and as they say, the higher the risk, the higher the reward. That's certainly true for oil and gases.
Yeah. And I'm sure there's an element similar to multifamily syndications where the operator's experience level and their track record matters, whether or not you're going to ride their coattails on the next well they drill, right? Because you might be like, okay, if it's Exxon or BP, yeah, we're going to follow them. But if it's a small startup, right, who's drilling, maybe you can't trust their expertise as much as somebody who's got a long track record.
Yeah, so I'd say our criteria as far as where we invest, like I mentioned, it's in those four mineral formations. Let me try to pull it up here. Major oil and gas formations. While I pull that up, you definitely brought up a good point. It's, you're buying the land, but you also want to make sure the company who's coming in to drill is competent and experienced, for lack of a better word. And so we only go once we know that it's a certain caliber of company that is going in to drill, so that we can be confident, right? And so the formations that we buy, I have it pulled up here in front of me now. The formations that we buy in are the Eagle Ford, the Niobrara, and the Bakken. I think there's one more in there. So that's one, right? Location matters just as it does in real estate. And then the operator matters also as it does in real estate. And then beyond that, it's, again, how many wells are you buying? What are you buying at? Another way we're being conservative, in addition to how many wells we buy, is just the pricing on oil and gas. We just want to be conservative there. Even if we think it's going to stay at, $80 a barrel, we might say, hey, let's just show $70 a barrel just to be conservative. So I would definitely warn people, and this is something that I encountered personally. I first started about oil and gas investing February of 2022. Pretty early on, like after I got into the syndication space. But a lot of operators will take advantage of the fact that people are looking for tax write-offs. They will put that out as bait, and innocent investors, unfortunately, are at risk of taking that bait because they just hear reducing your tax bill and they go bonkers because everyone wants to find a way to reduce taxes. But what people don't realize is if you invest 100K and you save 30 to 40K on taxes, like, good for you, but you still lost 60 to 70K that you could have otherwise invested into a multifamily deal. You might have paid more in taxes, sure, but you at least wouldn't have lost $60,000 to $70,000. So
Right.
yeah, operators definitely key, and they're definitely out there because the oil and gas space is less well understood than real estate. I feel like real estate is starting to mature as a space, and people are becoming more knowledgeable. Investors are becoming more knowledgeable about what to look for. Oil and gas is still a little vague, still a little murky, still a little shady. So people should definitely be aware when they look at investing in this space.
Did you watch the show Landman on FX? Taylor Sheridan's
No,
show?
no, but another podcast I was on, the host asked me the same thing. When I went into explaining what a landman was, they were like, I already know what a landman is. I'm watching the show.
You got to watch it. Like, I've only watched like the first few episodes,
Okay.
but just like you said, and the closing statement of that is like there's some shadiness that happens, right?
Yeah.
There's definitely some like backdoor dealings and some things that happen off the books that you have no control over, right?
Yeah.
You should check it out. I'd love to hear your impression on that show versus somebody who's just watching it from pure entertainment.
Yeah, I'll have to check it out.
Yeah. Very interesting. Well, thanks for digging in a little bit deeper into that. But like you said, like, I mean, you know a ton about it, but there's just so much to uncover with that kind of investment. And this is where I think a lot of, the average investors who only understand how to use a stockbroker to go buy, stocks, or maybe they invest in like a T-bill or something, that's pretty conservative, some mutual fund, that they just don't understand all of the complexities. And that's why someone with your experience is so important for them, to really help them kind of peel back the onion and see all of the benefits, understand the risks. But there certainly are way more opportunities to get a better ROI if you understand those risks and you partner up with people who have been there and done that.
I appreciate it. I would definitely not say that I'm an expert by any means, but I'm getting there, and that's the goal. And I think, I always think I always keep an open mind, about what's possible and what kind of things people are doing out there. When I first started in syndication, I used to be doubtful of the idea that people were hitting 15, 20% IRRs passively, conservatively with tax benefits. Now for me, that's the baseline, and the stock market doesn't cut it for me anymore. It's almost like being a drug addict. Like, multifamily is the gateway drug. Then you find these different investment opportunities. So I'm always keeping my eyes open, keeping my mind open. And I never get too comfortable. If my portfolio is doing 15, 20% return, I always think to myself, hey, there's someone out there who's doing better than I am. Like, what are they doing? And how can I get in on that? How can I learn more about it to make sure it's the right thing? Obviously, that it's not, I'm not investing into like a very risky meme coin or something that's fraudulent, but how can I find legitimate, risk mitigated or superior risk adjusted return investments?
Right. Yeah. There's so many opportunities, but you did say that you invest also in businesses, right? So you see it's small cap businesses, right?
We were about to invest into some when I found it, but then the returns weren't as great when we were looking at it. So that is something that we keep our eyes out for. I think that's another great opportunity here, especially with the silver tsunami. Baby
Hmm.
boomers retiring, businesses that are available to be bought up, is again, that's a space that's not as saturated as real estate just yet, I would say. And I feel like the returns and the risk profile there still makes sense.
Yeah.
So that
Have you heard
is
of Cody
something
Sanchez before?
I have. One of the entrepreneurs that I follow pretty closely. I have
Yeah.
her book, Main Street Millionaire. So
Yeah. I had
it's
an
definitely
opportunity
something
to
I'm
meet
interested
her
in.
at one of
Oh,
the masterminds I'm in. Yeah, she's just a wealth of knowledge and bigger than life person when you meet them in person. But yeah, I follow her too, and she's got so much good advice. And you're right about that silver tsunami. There's so many opportunities to invest in businesses, but if you can find something that's vertically integrated and something that you're already involved with, like for me, real estate, right? So, I use service providers all the time, and so a lot of real estate people are buying up, construction companies or window cleaning companies or the companies that provide services to the vertical they're already in, and that makes a lot of sense.
yeah.
Yeah.
What mastermind did you meet her in or meet her through?
It's called Owners Club.
Oh, interesting. Okay.
It's through Pace Morby and Jamil Damji's group, if you're familiar with them.
Yeah, I've heard of Pace Movie. I mean, who hasn't? Right.
Yeah,
Yeah.
very cool. So let's talk more about how you talk with investors, because you've got your podcast and part of your goal is to educate the average, say W-2 employee on the benefits and the risks of investing in real estate. Let's pretend that, we've got an audience here of people who are considering investing into a fund, a syndication of some sort, maybe one of your opportunities.
Yeah.
How does that discussion go when you're talking with somebody so that you can kind of get them up to speed on, what the opportunities are, what kind of return on investment they can get, and what are the potential risks?
Yeah. Usually I like to start my conversations learning about their career and investing background just to learn about where they're coming from, what their experience level is. I also like to learn about their investing goals. Like, is it financial freedom? And then like let's quantify it, right? Is it a net worth? Is it $5 million? Is it $10 million? Or is it passive income? Do you want just $10,000 coming in a month? Do you want $15,000 coming in a month? Like, what is a milestone for you? What's your North Star? From there, usually I just introduce myself, what we're doing, And then I just walk through the process of syndications and how they work, right? Because to anyone who hasn't invested into a syndication, handing over control of your capital to someone that's not the stock market is a mind-blowing and very scary concept. So usually, I'll say, hey, we pool our capital together to go out and buy bigger investments, whether it's real estate, land, businesses, private loans, whatever it is. We go out and pool our capital to buy bigger investments than any one of us could individually. Some of us are active and we manage the investment. We're the general partners or the GP or the active investors. And then most of us are limited partners, limited investor, or passive investors, LPs for limited partners. And then it's a matter of just saying, like the typical process is once we find an opportunity, we'll email you about it, we'll text you about it, we'll host a webinar where you can join live and ask any questions that you have. And for me, my target's usually 5 to 10 investment opportunities a year through the fund of funds that I run. So you have 5 to 10 opportunities. You can pick and choose also through the model that I employ which opportunities you want to invest in. So you can say, hey, Keshav, I love opportunity 1. I'm going to invest in it. And then when I bring opportunity 2, you can say, hey, Keshav, are you crazy? Why would I ever put money in that? And you can skip that one. So it allows that freedom to investors. Once they find something they like, then they move forward with signing the legal documents that we prepare. And our investments are monitored by the SEC, Securities Exchange Commission, same folks who monitor the stock market, because we're also selling securities at the end of the day. So we have legal documents, PPMs, private placement memorandums, we have OAs, operating agreements, we have subscription agreements, SAs, all these different legal documents. And sometimes we might need you to prove that you're an accredited investor, someone who meets certain net worth and income requirements. Once you do that, there's 3 ways that you can invest, right? The easiest way is cash, pretty easy. You have it sitting in your checking or savings account, wiring that over to the LLC. Second, which a lot of people are interested in, is using their retirement funds. So a lot of people don't know they can use their 401ks, their Roth IRAs to invest into our private equity opportunities through the self-directed IRA vehicle. And then third is leverage. For most people, their largest asset is their personal home. But you just have a lot of equity sitting trapped in there. Can we take out a HELOC? And maybe we're paying 8% or 9% on that HELOC, but home equity line of credit. But if we invest it into an opportunity that's returning us 18, 19% every year, then we make that spread between the investment and what our loan's charging us. So we're profiting 10% a year. And then beyond that, I tell them once we close, you can expect monthly or quarterly email updates and distributions as well. And around this time of year, February, March, April, hopefully as soon as possible, we'll send you your tax forms for the investments you make with us. And to get investors comfortable, I send them our past opportunities with all these documents so they can look at what a pitch deck looks like. They can look at our legal documents. They can look at our underwriting and see how we do our financial modeling. And then I send them, a link to our investor testimonials as well. And then it's just a matter of continuing to build that trust and continue to educate them. Just as, I wish someone had educated me personally. I had to ask a lot of the questions and, read a lot of books myself. But if we're able to proactively do that, then I personally think that's a better experience for investors.
Yeah. And it builds credibility as well, right? Because if they're thinking about this as an investment vehicle, you're probably not the only company that's knocking on their door to get their money to invest, right? So they're going to invest with somebody who they know, like, and trust, and who's held their hand, answered their questions, and isn't doing the hard sell. Just presenting the opportunity and saying, like, this is the opportunity here. And, if it's not for you, that's totally okay. But this is, what we expect, right? Here's all the paperwork, and just being 100% transparent on what the opportunity and the risks are.
Exactly.
Yeah. Tell me more about this leverage angle, because I haven't heard many people talk about it. And obviously, there's another layer of risk there, because if you take out a HELOC, there's going to be a monthly payment that you have to worry about.
Yeah.
How do you structure that? Is you do only do that if you know that you're going to be paying out dividends, or you explain to people in advance that like you're going to have to cover this monthly nut for the next 24 months or 36 months?
Yeah. So the HELOC stuff is a great avenue, but it applies broadly to any asset, right? Like you could take out loans against even your 401k, I believe. You could take it out against your stock portfolio. If you own art, you could take it out against that. Any asset-backed loan, but the HELOC's the most common one. And so let's say for easy numbers, the HELOC's charging you 10% interest every year. I think that's a little on the high side right now.
Yeah,
I
I heard a
don't
bit
own a
more.
home. Yeah, I don't own a home personally. So I don't have an idea of where the rates are. I think it's more like 8, maybe 9%.
Hmm.
But we have, for example, like our particular scenario, we have private lending opportunities, cash flowing opportunities where, you can easily make your payment and more. Because you're taking a loan to then invest into another private loan that's issuing even higher interest. And then it's a matter of evaluating how safe is that other loan that you're investing into. What's the default risk? What happens in the event of a default? What's your collateral, etc. But I'm a fan of using leverage to invest into private lending opportunities because those cash flow. And typically the collateral is pretty good. There's risk mitigants that we have baked into place. If not that, oil and gas could be a good opportunity. Also because, again, as long as you're investing with the right company, you get your capital back pretty quickly, right? Through a combination
Hmm.
of tax savings and the cash flow. It comes down to the individual investor's risk and reward appetite. I always leave leverage as the last option. Let's get your cash deployed, right? If you're in the stock market, I personally don't like the stock market. I have everything that I have is outside the stock market. So let's get you out of the stock market first. And once you've run out of cash to invest, depending on how much you want to liquidate your stock market earnings. I personally don't like it, so I'm all out of it. If you want to keep 40% in the stock market and keep 60% in private equity opportunities, then that's up to you. But whatever that ratio is, as much capital as we were willing to deploy, let's get that into these private equity syndication opportunities first. Second, let's explore the self-directed IRA route, get your retirement accounts working for you in private equity. And then third, once you feel comfortable, let's actually do a pro forma. Let's do some calculations on how much you might have to cover every month. Think about a worst case scenario and I don't want to call it best case scenario, just the normal scenario, like our projected scenario. And let's see how comfortable that gap between the returns and the debt service, if any, like what would you feel comfortable with, right? So for
Hmm.
multifamily, year one, if you're getting 6% cash flow, you're going to be in the hole 2% in year one. Can you make that payment out of pocket? If you're in a development, I definitely wouldn't recommend it for a development deal on an equity basis, right? Because development takes 3 to 4 years to cash flow. I would only invest using leverage into cash flowing opportunities. Like personally, that's a rule that I hold for myself at least.
Yeah.
Yeah.
Yeah. I like the idea of taking that money and lending it out. That makes a lot of sense, especially if it's backed by real estate, right?
Yeah.
If it's, fix and flip loans, or, loans that, pay monthly that you can get back and then charge points on too, to increase the ROI. And then if you could turn that money around 3 or 4 times a year, you're getting a really good ROI.
Yeah. Exactly.
Yeah. So is that one of the funds that you have, is a debt fund to lend money to those kind of either like bridge loans, fix and flip, or earnest money type situations on commercial deals?
Yeah, one of the private lending opportunities we have right now, pretty diverse lending, lends across 46 states.
Hmm.
And a portion of the revenue that we get from the interest is set aside as a buffer in case any defaults happen or anything like that. And we're achieving 16 to 18% return for investors right now, net of all fees and all that. So that's what I'm saying. If a HELOC's charging you 8%, let's say, and this opportunity is getting you 18% cash flowing every month to your account, then you profit that 10%, in between. So it's opportunities that I really like leverage for.
Mm-hmm.
Yeah.
Yeah, it's pretty interesting. What about people who have money in like a life insurance policy? Is that just another vehicle, or would you treat that any differently?
I would group that under asset-backed loans, right? Because I have
Mm-hmm.
a life insurance policy myself, and I'm building it right now, looking into how can I deploy it. And even there, the asset is the cash value that you build in the life insurance policy. So your policy is invested into, stocks and bonds, right? Some combination of. And the advantage is while it's growing in value in the policy, you can then take out loans using your cash value of the policy that you've accumulated as collateral. I don't view
Mm-hmm.
that any differently from, taking out a loan against a home or any other stock portfolio or asset. So also something I would
Yeah.
encourage, given you've done
It's
your
just
due
a lower rate,
diligence.
typically,
Exactly.
right?
Yeah,
4 or 5% out of your own cash balance compared to, what you would get a HELOC for from the bank, almost half.
exactly. Yeah. So that's
But you need
definitely
the
an avenue.
money in advance, right? So you have to move it from someplace else into the life insurance. But those can get, pretty good because now you're stacking because the money's growing in the life insurance policy, even if it's deployed into another investment. You just have to factor in that 4 or 5% debt service you got to cover when and if you decide to pay it back.
Exactly. It's pretty similar to the stock market, right? Like you can have a
Yeah.
portfolio accumulating in the market while taking out a loan against it and then using that to invest or just live off, right? That's how people always complain billionaires don't pay tax. It's because they're taking out loans against their stock portfolio, right? Like Musk is taking out a loan against his stock portfolio to fund his ventures, to fund his living. He's not selling his stock, thereby incurring, a taxable event. So stock market's no different from life insurance in that aspect. I'm a fan of life insurance more so because obviously there's so many more benefits. I would definitely encourage anyone to look into setting up a life insurance policy. I have one for myself and then another one for the company too. So
Do you mind talking a little bit about that? The way you formed it, is it was like a whole life insurance? Is it an IUL? Like, what did you
it's a
go with?
VUL,
VUL.
variable universal life insurance.
Mm-hmm.
It's better for folks. I have a lot of track ahead of me, like a long time horizon. So here, I think this just tracks the stock market better with the VUL, and it just purely tracks equities, right? So your risk is a little higher, but your reward is higher too over the long run.
Mm-hmm.
Other life insurance, I believe, tend to incorporate bonds more so. That's my understanding. I spent a year understanding this before I decided on a VUL, and then just have forgotten about it since. I still
Yeah.
contribute to it monthly, but it's just set up on, like auto fund, auto pay, basically.
Right.
But that VUL, the big benefits that I took from it is one, that it's invested in equities. And so it's accumulating, doing its thing, while I can take out loans against it and use that to invest and grow my money, not only in the portfolio, in the cash value of the life insurance policy, but also outside of it in the investments that I'm making with the leverage, we'll call it.
Mm-hmm.
Two is the ability to rearrange my allocation within the portfolio. So this is one benefit that it has over the traditional stock market is that you can buy and sell and rearrange your portfolio tax free, meaning you can be all in on equities. If you think we're nearing the top of a bull market and you think things are going to start going south, you can reallocate all of your earnings, like your entire portfolio, into bonds, move it into a safer position, not pay any taxes at all, let that ride out and grow whatever 3 4%, wait until we hit a low, and then reinvest, buy back in to equities at the low.
Mm.
So that's a great benefit there. I'm pretty sure
Yeah.
you can also do that in retirement accounts too, right? Like that's the whole point of a retirement account, is to avoid paying taxes. And I think the other big benefit is obviously the life insurance, the part of it, right? The death benefit is another big part. So I would
Did
say
you
those are some
structure
of
it in a way to maximize your cash value and minimize the life insurance portion of it?
yes, yes.
Yeah.
Because I have a long runway ahead of me. I'm 20, just turned 27 recently. So,
Right.
pretty low fees up front, minimizing the life insurance up front, just because I take pretty good care of my health, focusing
Hmm.
on the growth aspect of it over the next,
Yeah.
fingers crossed, 50, 60, fingers crossed, 70 years.
Yeah. And then the tax benefits too are pretty amazing because it grows tax free while it's in that vehicle,
Yeah,
which,
I wish
yeah.
more people would take advantage of that. But it's like you said, it's a matter of us educating people, so hopefully in the efforts that, you're doing here on your podcast, the content that you're putting out, the content that I'm putting out, more and more people will set up life insurance policies, become more financially educated, and be able to better take care of the people they care about.
Yeah. That's pretty cool. So tell me about your podcast. Do you just talk? Is it you talking? Do you interview people? What's the concept behind your podcast?
Yeah, our podcast is called Investing for Generational Wealth. My business partner, John, hosts those episodes now. And the goal there is just to educate our audience about all things finance and investments related. Um, Outside of the traditional, we skip past the basics of saving and budgeting and 401k and Roth IRA, all of that.
Hmm.
We're educating people on how to invest into private equity opportunities like the syndications that we put together. We're educating them on how to use their retirement account funds to get into self-directed IRA accounts. We've hosted a few episodes on life insurance, but we probably will do a little more on that. And I want to incorporate more general financial topics, right? Like asset protection, setting up trusts and
Hmm.
wills, you know, things like that. So once you do make your money, once you do make your returns to your investments through your investments, how do you pass that on to your children? And how do you, or like, whoever your beneficiaries are, and then how do you, more importantly, protect it in the very litigious society that we live in?
Yeah. Are you incorporating any sort of current events and news into the talks? Because there's so much it's changing now, just from like November to now. Like it's an entirely different, financial landscape, and the economies are going to be changing, I think, dramatically based off of some of these changes that are happening. Is that part of the discussion? Is like, okay, here's some new policy changes. This is how it's going to affect how you invest.
That is part of the discussion as well, yes.
Yeah. I think it's something that what we've tried to do as well is pay attention to, you know, the current events, news, just to keep it fresh. Because you can only talk about, how to invest in a syndication a couple of times before it starts to get pretty dry. And
Yeah.
then you got to find something new to talk about.
Yeah, and I think that's also where, since we're diversified across so many opportunities, there's always something to talk about, right? Like the real estate market. Real estate and debt might move in lockstep more or less because they tie pretty closely to, interest rates, things like that. But I think oil and gas is a
Hmm.
completely different line of business.
Yeah.
And I think, even like when we hopefully do get into small businesses, I think that's a completely whole new arena too. So yeah,
Are you guys
definitely hear
interviewing
you there.
people yet? Or is it just you guys just talking?
About oh, we've primarily been interviewing people actually. We're
Or have
switching
you?
to more, like, I want us to switch to more myself and John talking, so that not only are we bringing other experts on, we kind of showcase what we know so far and begin to position ourselves as hopefully, subject matter experts, knowledgeable people
Yeah.
to talk to.
Yeah, that's a smart move. Very cool. Well, Keshav, thank you so much for taking the time. Learned a bunch from you today. You're a wealth of knowledge, even at 27. You've lived probably a couple lifetimes. So congratulations on the fund and the growth of your business, the podcast. If anyone's interested in working with you, where can they find you?
There's three ways that people can reach out and learn more. One's definitely LinkedIn. Reach out to me over there, Keshav Kolur. one of the only ones out there that I've found, so it should be pretty easy search. And our website, clivecap.com/alternative-assets. Our website's a host of educational resources, but this page in particular is great for starters. We include a 100-page due diligence checklist that you can ask regardless of what you're investing into. General questions, just like regarding the person you're investing with, what's your background? What's your track record? Tell me about a time a deal went south. Why did it go south? What did you learn? How did you communicate with investors? What have you changed since? And then testimonials, right? Like provide me testimonials with your current investors, banks that you work with, CPAs, attorneys, etc. Just making sure that you're investing with the right people. That's what that checklist is about. And we also have an ebook and a 2-pager that go into why you should be investing outside the stock market. It's mostly real estate focused, but the benefits that we go into as far as appreciation, cash flow, tax benefits, why you might not have heard of syndications, because I certainly didn't, and it is mostly around regulations, legal regulations. We just delve into all of those. So our website's definitely a great spot. And then lastly, our podcast, Investing for Generational Wealth. You provide a lot of value here, and I hope that I'm providing as much value there as well, but would definitely encourage listeners to check us out over there as well.
Awesome. Keshav, thanks again for being with us. Really appreciate your time. And everybody, thank you so much for listening today. Keep an eye out for more amazing guests like Keshav on future editions of the REI Hacker Podcast, where we talk about business, real estate investing, entrepreneurship, and just a bunch of exciting people who are doing, making big moves in the real estate business. So thanks again for listening, and we'll see you next time. Take care.
Thanks so much, Ben.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.